Have you ever wondered how someone like Warren Buffett would actually break down a stock? What would he look for? What are the critical questions he'd ask? Well, that's exactly what we're going to do today. We're pulling back the curtain, using his simple two-part framework to put the pharmaceutical giant AstraZeneca right under the microscope. So, let's dive in.
You know, Buffett's whole approach isn't about some complicated algorithm or just chasing whatever's hot in the market. Nope. It's really about answering two very basic questions, which he summed up perfectly in one of his most famous quotes.
This right here, this is our entire roadmap for today. It gives us a super simple two-step checklist. First, is AstraZeneca what he'd call a wonderful company? And second, is it trading at a fair price? Let's start with that first big question.
So what does wonderful even mean? For an investor, it really comes down to a few key signs of a genuinely healthy business. We're going to look at 3 specific numbers that tell us a story about its profitability, its growth, and its stability.
Okay, our first number here is all about profitability. It's called return on equity, or ROE. And AstraZeneca's ROE at over 21% is really, really strong. It basically tells us that for every single dollar shareholders have invested in the company, the management is able to generate 21 cents of profit. That kind of efficiency, that is a huge checkmark in the wonderful column. All right, next up, growth. This number shows AstraZeneca's 5-year net income growth rate. Now think about that. Growing your profits by over 26% every single year, compounded, that is seriously impressive. It shows that their profitability isn't some one-time fluke. It's a solid, consistent trend over the long haul. And finally, let's talk stability. This is the debt-to-equity ratio, and it's a quick way to check financial risk. Now, a general rule of thumb is that anything below 1.0 is considered pretty healthy, and AstraZeneca comes in at 0.61. This tells us the company isn't propped up by a huge mountain of debt, which means it's standing on a much more stable foundation. So let's just recap the first half of our little checklist. We've got high profitability, really strong growth, and low debt. I mean, the evidence seems pretty clear. Based on these numbers, AstraZeneca absolutely looks like a wonderful company. But remember, that's only half the story. And this is where our story takes a really dramatic turn. Because even the most wonderful company in the world is only a great investment if you don't overpay for it. So now we have to ask the really tough question, what's the price tag?
So to figure this out, we need to compare the price on the stock market to a calculation of its actual intrinsic value. And what we find here, well, it highlights one of the biggest challenges in all of investing.
I mean, just look at this gap. The market says the price is nearly $190 a share. But one very common way to calculate its fair value, which is based on future cash flows, says the company is actually worth just under $100. That is a massive disconnect between the price and this particular estimate of its value.
This number represents something investors call the margin of safety, and honestly, it is jaw-dropping. See, you always want a positive margin of safety. That means you're getting a bargain, you're buying at a discount. A negative 90% margin? Whoa! According to this specific model, that suggests the stock is trading at a huge, huge premium. It's practically screaming that it's overpriced.
And there it is. That's the conflict. We have what looks like a fantastic business, but what looks like a terrifyingly high stock price. So is it really that simple? Is this just a wonderful company at a terrible price? Or is there maybe more to the story?
You know, in investing, one number almost never tells the whole story. What if that high price is actually justified because of incredible growth? Let's bring in one more tool that can help us try to untangle this whole puzzle.
This is the PEG ratio. The easiest way to think about it is it helps you see if a stock's price is fair relative to its growth. It basically puts the famous P/E ratio into context. The key thing to know is a low PEG ratio, anything under 1.0, might be a sign that you're getting a real bargain on a fast-growing company.
And will you look at this? AstraZeneca's PEG ratio is 0.64. Because it's so far under 1.0, this number just completely flips the script. It gives us a really powerful counter-argument. It suggests that, hey, once you factor in the company's amazing growth, maybe that price isn't too high at all. Maybe it's actually a pretty good deal.
And just to make things even more complicated, it turns out fair value isn't some single magic number. Remember that scary negative 90% margin of safety we saw a minute ago? Well, that was based on just one model using free cash flow. As you can see here, a different, totally valid model based on earnings per share gives us a much higher fair value and a much less scary margin of safety. So which one is right? That is the fundamental challenge.
So this is where we land, right in the middle of a classic investor's dilemma.
We've got one set of data that tells us the company is a high-quality machine, and we have another set of data giving us completely conflicting signals about whether the price is fair. Let's just lay this whole puzzle out on the table. On one hand, you've got strong profitability, impressive growth, and low debt, all clear signs of a wonderful company. But on the other hand, you've got a high current price, a terrifying margin of safety from one model, and a really favorable growth signal from another. This right here is the exact dilemma investors wrestle with every single day.
And that really gets to the heart of this whole thing. The Buffett checklist was never supposed to be some magic formula that spits out a simple buy or sell. It's a mental framework. It's designed to force you to dig deeper, to weigh conflicting evidence, and to really understand the full story that the numbers are trying to tell you. And so we're left with the ultimate investor's question. When you find a truly wonderful company, how much are you willing to pay for that quality? At what point does the price just get too high, no matter how great the business is? You know, there's no easy answer, and that right there is the central challenge and the thrill of investing. Thanks for digging into this with me.